Today, we're putting companies on the examination table for a full financial health checkup. We're going to use a really powerful set of tools, financial ratios, to look right past all the hype and see what's really going on under the hood of a business.
You see the headlines everywhere, right? Hot new stock, a booming industry, some company that's supposedly changing the world. But how can you tell if that foundation is actually solid or if it's just, a house of cards? How do you separate the story from the reality?
Well, the answer is to give it that financial health checkup. And for this, you don't need a stethoscope. You need a detective's toolkit. That toolkit is financial ratio analysis, and it's how we're going to look past the stories and get straight to the facts.
So, what exactly is ratio analysis? Basically, we're just taking numbers directly from a company's financial statements and using them to create these powerful little metrics. These ratios give us a clear, objective look at a company's performance and stability, letting us actually quantify its overall health.
Okay, so every good investigation starts with a really fundamental question. For us, it's this: is the company actually making any money? It seems so obvious, but you would be surprised. Let's start right there.
Our first tool from the kit is the net profit margin. This ratio just cuts right to the chase. It takes the company's net income, that's the real bottom line profit after everything has been paid, and it divides it by the total revenue. This tells us exactly what percentage of each dollar in sales the company actually gets to keep.
Let's put that into really simple terms. A 10% profit margin means for every single dollar the company brings in from sales, it keeps just 10 cents as pure profit. The other 90 cents? Poof, it's gone. Used to cover all the costs, from materials and salaries to taxes and everything in between.
But here's the thing, and this is super important. A number all by itself is pretty much meaningless. Let's say a company has an 8% profit margin. Is that good? Is that bad? Who knows? But if the industry average is 12%, well then suddenly that 8% looks pretty weak, doesn't it? Context is absolutely everything. A software company might have a 25% margin, while a grocery store chain could be perfectly healthy at just 2%. You always have to compare a company to its peers.
All right, on to our second key question. A company can look profitable on paper, but if it's buried under this mountain of loans, that's a huge red flag. So we have to ask, is it drowning in debt?
To answer that, we're going to use another classic metric, the debt-to-equity ratio. This one directly compares the company's total debt to the amount of capital that's been invested by its shareholders, which is what we call equity. In short, it tells us exactly how much the company is relying on borrowing money versus its own funds to run the business.
So how do you actually read this number? Well, a debt-to-equity ratio of, say, 0.42 means that for every dollar of its own money funding the business, the company has borrowed 42 cents. A higher number generally means more risk, but again, and you'll hear me say this a lot, it really depends on the industry. A stable utility company might be able to carry way more debt than a volatile tech startup. And that brings us to our third and final question for this checkup. This one is all about the short term, the here and now. Can the company pay its immediate bills? Does it actually have enough cash on hand to keep the lights on?
For this, our tool is the current ratio. It's a really straightforward measure of what we call liquidity. We take all the company's current assets, so things like cash or inventory that can be sold within a year, and we divide them by its current liabilities, which are just the bills that are due within that same year.
Okay, we run the numbers for our hypothetical company, and we get this: a current ratio of 2.
And that number, that 2, tells a really crucial story about its short-term health. It means the company has a really strong financial cushion. It has $2 of liquid assets ready to go to cover every $1 of its immediate bills. Generally speaking, anything over 1 is considered healthy, so a 2 is a very, very comfortable position to be in.
So, let's recap. We found that our company is a bit less profitable than its peers, it has a manageable amount of debt, and it's in a comfortable spot to pay its bills. We've gathered our clues, but just like any good detective, we know they're most powerful when you put them all together to see the whole story.
That's because these numbers don't exist in a vacuum. They actually weave together a narrative. For example, a highly profitable company might be taking on huge amounts of debt to fuel its growth. On the other hand, a company with no debt might be struggling to generate enough cash. The ratios only really make sense when you see how they all connect.
This whole concept is often visualized as something called a pyramid of ratios, and it shows how dozens of these smaller, specific metrics, like say how fast a company sells its inventory, all connect and build on each other. They ultimately flow all the way up to drive the single most important measure of performance, return on equity. This is how you see the entire financial story finally come together.
So what are the key takeaways from all this? First, just think of ratios as powerful questions. Is the company profitable? Can it pay its debts? Second, remember that a single number is absolutely meaningless without context. And finally, you have to always use comparisons. Compare against the industry average and against the company's own history. That's how you uncover the real story.
You now have the basic toolkit to start your own investigation. You can look past all the headlines and start asking the right questions. So I'll leave you with this thought. The next time you hear about a company, what's the first question you're going to ask to check its financial health?